The formula for break-even point or desired sales would be the numerator divided by contribution margin ratio or contribution margin per unit. But there are three products here. When there are three products, that would be multiple products. So in case of multiple products, what do we do? What is the formula? The formula would be the same, but the denominator will become weighted average contribution margin. Once let's look into the slides and then understand that. So if it is multiple products, so multi-product break-even analysis. Break-even point is equal to fixed cost divided by weighted average contribution per unit or weighted average contribution sales ratio, contribution by sales ratio. Now the same thing is applied. Whatever is the numerator, the denominator should become weighted average contribution per unit or weighted average contribution by sales ratio. So the situation here, it is multi-product. There are three products, F, P, and G. And the proportion is given 6:5:4. Now, when the proportion is given, what is that we have to do? We have to find out what is the um, weighted average contribution margin ratio. That is what we have to do. So let's take it up. Question number 190. What are we to find out here? If the fixed cost is given as 160, the revenue needed to earn a sales marginal costing profit. So here we have to find out what is desired sales is equal to, the numerator would be fixed cost plus the profit margin divided by weighted average contribution by sales ratio. Earlier also we've discussed about what is the formula of weighted arithmetic mean. What's the formula? The weighted arithmetic mean formula is x bar w is equal to sigma wx divided by sigma w. What are weights here in this case? X is anyway the contribution margin ratio, because that is what is the main parameter here, contribution by sales ratio. So we have all of the three of them. Then we need to know what are the weights. Weights are these things, 6, 5, and 4. The sum total of that will be 15. So each contribution margin ratio should be multiplied with its respective weight. So the formula goes like this. The first set, which is 6 into 6 is the weight into 35%. Then we have plus 5 into 20% plus 4 into 30%. Sum total of the weights is 5 plus 6 plus 5 plus. Find out what is that. Tell me what is the value.
Ma'am, 0.29.
0.29. Is that the answer? Okay, so once we have the denominator, I think we can proceed further with the solution. Desired sales is equal to, the numerator has fixed cost amount is given as 160,000 plus the expected it's given as 40,000 divided by 28.67%. So round it off to the nearest thousands is what is given. 697. So 698,000. Option C. The next question, 193. Our company currently sells products S, T, and U in equal quantities and at the same selling price per unit. The contribution to sales ratio for product S is 60%, for product T it is 45%, and total is 52%. If fixed costs are unaffected by mix and are currently 25% of sales, the effect of changing the product mix to is that the total contribution by total sales ratio changes to. There are two things which are mentioned. At present, they are currently selling the products SC, ST, and U in equal quantities. So the weights are equal weights. So three products are there. So weight can be mentioned as the ratio of weights can be mentioned because they are in equal quantities. One third, one third, one third. The sum total will become one. The contribution to sales ratio for product S is 60%, T is 45%, then the other one is 52%. If fixed costs are unaffected by mix and are currently 25% of sales, the effect of changing the product mix too. So at present, the product mix is in the ratio of 33.33%, 33.33%. So that is the ratio. Let's press at present and the proposed one. We have S, T, and then U. The present weights for S 33.33%, or you can just write it as 1 by 3 to for the comfort sake, because the proposed weights are 45%, 20%, and we have it as 35%. Then another set of information what we have is if fixed costs are unaffected by mix. So either case, both the present and the proposed change, the fixed costs are unaffected and are currently 25% of sales. The effect of changing the product mix to this is that the total contribution by total sales ratio changes to what? The contribution to sales ratio for product is 60%, T is 45%, and the total is given as 52%. So first, this is a missing figure which has to be calculated. Find out what is missing figure. The total contribution if it is 52%, and what is the percentage of this one? has to be taken into consideration. So what's the formula for weighted average contribution margin ratio? Let's present it as one third. So just for convenience sake, put it as 60% into 1 by 3 plus 45% into 1 by 3 plus, we do not know. So let's put it as u into 1 by 3 divided by 1. Because 1 by 3, 1 by 3, 1 by 3 added up together, it becomes 1 is equal to 52%. So 20% plus 15% is 20, 50, 35%. 35%, find out and tell me how much would it be. 52 minus 17%. U is equal to, it becomes into 3, no? Is equal to 17% into 3. So that's 51%. Use percentage, we got it as 51%. So here, this is the balancing figure. Find out what is 50, this one, 51%. It says if the fixed costs are unaffected by mix and are currently 25% of sales, that's not the issue. In either case, both the situation, whether it is the present or the proposed, fixed cost percentage, fixed cost amount is basically 25% of the sales value, but we do not even know what is sales value. So that is now, for the moment, it is not relevant, because the question is only focusing us to find out about what is the total contribution by total sales ratio. That is the weighted average ratio after the change is made, after the proposed change of the product mix. Now, the contribution per sales ratio would be the same. Here we have it as 60%. Then we have 45%. Then we have 51%. In that case, what is the weighted average contribution by sales for the proposed one? So the same way we would present it and then calculate that. So proposed, under the proposed category, contribution by sales ratio is equal to, let's present that the first one would be 60% into 45% plus 45% into 20% plus 51% into 35%. $53.85.
Ma'am,
Yes.
why are we taking the contribution sales ratio the same as for the proposed one, ma'am?
Contribution, once again, please.
Ma'am, the contribution by sales ratio we have taken for the proposed one, why we are taking it from the present one, ma'am? Like the same.
There is no change which is mentioned for that. The only change what happened is to the product mix. The rest of it is the same because there is no other mention about it. The only thing what they are as of now taking into consideration is the change in the product mix. The product mix earlier was in equal quantities. Now the product mix has changed to 45, 20, and 35%. The rest of it is all the same. If there was some change in that, it would have been mentioned. It is not mentioned. They at present they are selling in equal quantities and at the same selling price per unit. The contribution to sales ratio per product is this. Now, what is contribution by sales? The if the contribution, if any of these numerator and denominator variables change, then C by S ratio changes. But do we see any such thing which is mentioned about there is a change in contribution or there is a change in sales? There is nothing which is mentioned about contribution, sales, about fixed cost. There is no change. It is all about the weights which have changed. When the weights have changed, we are making the change in the weights and calculating what is the weighted average contribution by sales ratio, the total amount. That's it.
Okay, ma'am.
The next one. 194. EFG company manufactures three products which have the following cost and demand data. Product E, F and G, contribution to sales ratio, maximum sales value, minimum sales value. There are fixed costs of 850,000 per period. The lowest break-even sales value per period subject to meeting the minimum sales value constraint is nearest to. So break-even sales value is equal to fixed cost, which is 850,000 divided by, we have the weighted average contribution margin by sales ratio. Subject to meeting the minimum sales value constraint is nearest. Minimum sales value is given, maximum contribution margin ratio. There is constraint, minimum sales value constraint is nearest to. Here the decision criteria is dependent on demand. The following cost and demand data are given to us. Contribution per sales ratios are also given. Then after that, we have two different sets of data. One is about what is the maximum sales value, what is the minimum sales value. The question is asking us what is the lowest break-even sales value per period subject to the minimum sales value constraint. See, the constraint is it is not allowing the firm to take decisions to maximize the profitability. If something is a constraint, something is hindering the company from achieving its objective, then we call that to be as a constraint. Here also, they say that there is a minimum sales value, there is a minimum demand. Now, there are three different products, each giving different amounts of contribution margin. If the sales values are 400, 400, 400, assuming that it is only 400. Now, 400, the demand of minimum demand of 400, if that is taken into consideration, what's the total amount of contribution which is earned? But break-even point is a concept where we see break-even point is a concept where there is no profit, no loss. We know that. No profit, no loss is a situation where the contribution is equal to fixed cost. So that we have already discussed yesterday. Contribution and fixed cost should be equal. Now, what's their fixed cost? Their fixed cost is 850,000. So if there is minimum sales demand, the contribution earned is what has to be looked into, whether it is sufficient enough to um, recover the or absorb the fixed cost of 850,000. So let's check what is the contribution. What is the contribution? If the sales value is only 400,000, 400,000 and 400,000. Minimum contribution. E, F and G. In this case, E earns, if it is 400,000, 400,000 into 30%. So is equal to 400,000 into 30%. Then we have the other one also 400,000 into 20%. Then for the other one, we have it as 25%. So if the minimum amount of sales are met, what is the total contribution? The total contribution earned is, in case of minimum sales, is only 300,000. But whereas it would not break even at this point, which is 300,000, because to break even, the total contribution should be at least sufficient enough to recover their fixed cost, but fixed costs are at 850,000. So that is the point here. Fixed cost is equal to 850,000. So now they will not break even if the situation is at the minimum sales level. If they have the minimum sales level of 400,000, 400,000 and 400,000 for all the three products, in that situation, they will not be able to arrive at the break-even point. So if they cannot arrive at the break-even point, now they have to decide on what is the lowest break-even point which has to be achieved. So that is what would be considered. Among the three products, see the one with the lowest contribution margin per ratio is 20%. So that will be considered at that will be given the least preference. The one which is at highest contribution margin, which is 30%, this is highest. The least is at F. So now they have to decide upon what is the strategy which they have to adopt, so that by selling um, the lowest possible thing, they would break even. So how many units of each of them, or how much value of sales if they make, they can arrive at the break even point. To arrive at the break even point, additional sales required. Additional sales required to break even is equal to Okay. Minimum F will be kept at minimum because that is giving the least amount of contribution. Rather, now they should focus on producing the other products in larger quantity so that they can arrive at the break-even point. Now they have to think about increasing their contribution. By how much they have, their contribution should increase to the extent of 550. First preference will be given to product E. Product E can go up to a maximum demand of 1,200,000. So if it is 1,200,000 of sales which are to be taken up, now 1,200,000 into 30%. 1,200,000 into 30% will give the contribution margin. Why are we starting with E? Why are we starting with E? E is the one which is giving the highest contribution. Now the focus should be on increasing their contribution. But out of this 1,400,000, this part is already included here. E, this one, it is already included here. So apart from that 400,000, the rest of it will give the additional contribution. So we are focusing on pooling up to the extent of 550,000 of contribution, so that the contribution, the total contribution equals to 850,000. When it reaches 850,000, it would break even. Okay. Contribution should be equal to fixed cost. Already, by considering the minimum sales values of 400,000 for all the three products, the total contribution which is earned is 300,000. Now we have to pull up another 550,000 contribution so that it becomes total of 850. Then it can break even. Now, additional contribution by product is equal to, already 400 was considered here. So 400 into 30% part of it only was 120,000 included in 300,000. So we are not considering that. So from 1,200,000 minus 400,000, that's the sales value which is deducted, into 30% is equal to. So this is 240,000. Still how much more is needed? How much more is needed is 550,000 minus 240,000 is 310. Now 310 will have to be earned from product G, because the next in the order, if we rank them, next in order is product G. These products are giving better contribution margin ratios. So consider the next one, next in the order. Next in the order, product G. Product G already 400,000 we have included. Now, how much more is considered for sales? That it equals to 310,000. That's the logic here. The percentage is 25%. The required amount of contribution is 310,000. So what do we do? 310,000 divided by 25%. Just check that. We want 310,000 contribution which is expected to be earned from product G. So if that is the case, now, how many number of units? Now, this 310,000 will be contributed by product G. So, which is 310,000. We already got that. So, now decide on the product mix. So, how many units of product? Now, already we have decided keeping this minimum sales constraint as it is. The least profitable one is F. So, F will be, if needed, I'll put some more explanation, but let me write first the product mix. product mix of E, then we have F, then we have G. F anyway is only 400,000 because that's the least one what is contributing. 400,000 is the sales value. The contribution which it is giving is 80,000. Next part of it is we are looking at product E to the maximum 1,200,000. We're looking at that as 1,200,000 because the total contribution which is contributed by that would be 1,200,000 into 30%. The rest of that 360 plus 80 or 440. Is that so? So the additional contribution of how much more? 410 will be contributed by G. So G will contribute additional 410. So for contributing 410,000 of this is contribution. These are sales. Don't worry, I will once again explain. This is contribution. To have the total sales of already here we have it as 400,000. So altogether, if the contribution generated, if it is 410,000, the amount of sales would be 410,000 divided by 0.25. Okay, so this is the I don't know how much you got it, but let me put it. I'll erase all the writings here on the screen, scribbling on the screen. See, we have only, I mean, we have a different set of information, not the usual way wherein we can use the equations of what is break-even point is equal to fixed cost by contribution margin ratio. That part is not provided to us, but there is a different set of data which is provided to us, which says that there are three products E, F, and G. Their contribution margin ratios are mentioned. The maximum amount of sales which can happen, the minimum amount of sales which can happen. But overall, their fixed cost is 850,000, which has to be recovered from the contribution margin. Then only they will be able to arrive at what is the break-even point. Break-even point is a point where there is no profit, no loss. So that point, the total contribution earned should be equal to fixed cost. So contribution, if it recovers the total amount of fixed cost, their profit will be zero. So that is what is our aim. But they are also mentioning here in the question that the lowest break-even sales value per period subject to the to meeting the minimum sales value constraint, which means that we have to ensure that at least 400,000 of each of these products has to be taken up. See, normally what is done is if there is no such specification, we rank these products. This will be ranked 1, this will be ranked 2, then this will be ranked 3. The ones which are more profitable. So all 1,200,000 into 30%, so 360. The second in order is G. G, if we take all 1 million, I'm just writing it here. Let's check this one. If 1,200,000 and this is 30% is considered, how much contribution will be earned? The next in order is product G. Product G is 1,900,000 because that's profitable with a contribution margin ratio of 25%. If that is what we are considering, see, the criteria is to arrive at the criteria is to arrive at 850,000 of fixed cost. These two products itself with this sales amount of 1,200,000, 1,900,000 can generate a contribution of 835,000. So the balance of 15,000 will be pulled up from F. That is the normal situation. But there is a condition mentioned that minimum criteria should be met. Minimum sales demand criteria should be met for all the three products. If we do not consider that, according to the ranking, E will be first produced, which will give a contribution of 360,000. G will be produced, which will give a contribution of 25% and 475. Added together, the total contribution is 835. And then how much more is needed? Only 15,000 is needed. So 15,000 will be pulled up from product F. If only 15,000 is to be pulled up from product F, very little, less than 400,000 only will be. But here the condition is very, very specific that meeting the minimum sales constraint. So all three of them should have the minimum sales requirement. If there is a minimum sales requirement, see the contribution which is earned from the minimum sales, the minimum sales are 400,000. Maybe your into the contribution margin is 30%. Then here in this case we have for F it is 20% and G it is 25%. If this is how contribution is calculated, the total contribution is coming up to 300,000. But what is the criteria? Contribution should be equal to 850,000. If it is not 850,000, just give me 1 second. sorry about it. Okay, so where are we? Sorry about it. Um, if according to the profitability, if we consider a product E, G, and F in that order, we see the minimum criteria will not be met. So first thing is minimum criteria has to be met. If the minimum criteria is met, the total contribution is only 300,000. How much more? It's not sales. Additional contribution required to break even. I didn't write it properly. Additional contribution required to break even is 550,000. So we are focusing on additional contribution. Now, how to decide on that? Anyway, they have to break even. Now, if they have to break even, then in that case, consider the product which can give more amount of contribution. Now, the criteria is to touch that level of 850,000 contribution. So, 850,000 contribution, if it has to be met, look at the most profitable one. Most profitable one is E. Already E's 400,000 sales and contribution is considered here. We've already taken the minimum. So how much more will be considered? Only 800,000 from 1,200,000. 400,000 is deducted and 30% contribution is 240,000. So then how much more is required? How much more is required is only 310. That will be taken from product G. So then now let's decide on what is the mix. What should be the sales that the total contribution equals to 850,000. E already total amount of 1,200,000, 400 here and 800 here. Together, both of them, 1,200,000. The total contribution of 1,200,000 comes up to 360,000 here. F is only minimum 400,000 because G is already pulling up that. So if we see 310,000 contribution divided by 25 percent will give us whatever is the required amount of sales. 1,240,000 sales if they are made. I think that will give that required contribution of additional 310,000. But the total sales are 1,900,000. So it can comfortably pull up whatever is the required contribution. So on that criteria, we prepared this table. So E is this much. F anyway will be only 400,000. G. Now G has to contribute the rest of the contribution. The rest of the contribution. Now these two have contributed 440. The balance of contribution of 410,000 should be pulled up by product G. So if it is 410,000 contribution, the total sales which it has to be pulled up is 1,640,000. How did we get that? 410,000 divided by 0.25 gives us 1,640,000. Add up all the three sales, we have 3,240,000. Total contribution is 850,000. So that is the criteria which has to be met. I don't know how far you got it. Any doubts specifically addressed, so we can take it up.
Ma'am?
Yeah.
Ma'am, actually, I didn't understand that two statements, ma'am. Additional contribution by product T. Actually, why we are minusing that 1,200,000 and minus 400,000, ma'am, and the second statement also, ma'am. So why we are doing this to find out what, ma'am?
The point is, see, the question is we have to find out the break-even sales. Break-even sales, when will it break even? This part. I think there is a clarity here. But the second condition here is minimum sales constraint has to be met. So if we have considered all the minimum sales criteria, E, F, and G, all of them are sold at 400,000. Contribution which is given by E, F, and G added up together, it is only 300,000. But how much should be the total contribution? Total contribution, if it is 850,000, then only it will break even. So that is the point here. Because we have now how much more should be pulled up because already 300,000 is here. To meet 850,000 requirement, it should be 550,000. This is clear. Is this part clear?
Yes, ma'am. I got that clear, ma'am.
Done. Then here we've already considered 400 for E. Why are we selecting with E? Why are we starting with E? We are starting with E because E is the most profitable with the highest contribution margin of 30%. So altogether 1,200,000 is the sales, because 400 we've already added up. We have already calculated here. So the rest of it only will be considered here.
Okay, ma'am. But why we are calculating that 300,000, then below, like we are calculating dividing by 25,
That I
1
will.
million?
Is E clear? Is
Yes,
E
ma'am.
part clear? Okay, E is clear. Now how much more is required? 310 is 310,000 more contribution is required. We are testing whether G can contribute that additional 310,000. We are just testing it. We are testing it because um, whether that maximum capacity of 1,900,000 will be able to contribute. So is it within that limit? That maximum is 1,900,000. So how do we know? If it is not the case, then we also have to approach product F, whether G can give the remaining amount of contribution. So what did we do? The remaining contribution is 310,000. Okay. So what is contribution? Contribution is equal to, how do we get that contribution amount? Is equal to sales into
Minus very. Sorry.
C by S ratio, into C by S ratio, the percentage. Okay, so we know contribution is 310. We know contribution by S ratio is 25%. So how much sales is what we are calculating. So this C by S goes to the other side. It becomes 310,000 divided by 1,240,000. So that is what I was just testing here. So 310 divided by 25% is 1,240,000. 1,240,000 plus this another 400 is there. So 1,640,000 is within the reach of 1,900,000. It is only verification sake I have done this calculation. So here 1,240,000 we got it. Already another 400 is considered here. 400 plus 1,240,000 is 1,640,000, is within the limit of 1,900,000.
Okay, ma'am.
So
Now I
G will be
understood.
able to contribute. So now let's decide on what is the product mix. E is taken to the maximum 1,200,000 and contributing I think comma if I put, I think there will be clarity. And this is 360,000 contribution. This is 80,000 contribution. F is only, now G has to be decided on how much will it be contributing. So additional contribution is 410,000. So for a contribution of 410,000, sales will be 410 divided by 25%. Add it up, it is 3,240,000.
Yes, ma'am. I got it.
I think with practice you can arrive at that state. I mean, it doesn't come just like that overnight, because these are little logical. So don't have to be worried that you didn't. I think if you practice again and again, it becomes clearer to you the concept. 195, question number 195 says, our company manufactures and sells two products SNT. Annual sales are expected to be in the ratio of 3S is to 5T. Total annual sales are planned to be 640,000. Product S has a contribution to sales ratio of 32%. T has 48%. Annual fixed costs are estimated to be 200,000. What is the margin of safety percentage? Margin of safety percentage is margin of safety divided by the budgeted sales. Okay, margin of safety divided by the budgeted sales gives us, let's start writing. Question number 195. We are asked to calculate what is the margin of safety percentage. Is equal to margin of safety divided by budgeted sales into 100. That's the formula. But do we know what is margin of say? I'm really sorry. What did I write? Margin of safety. Sorry, not sales. So what is margin of safety is what has to be understood. What is margin of safety according to the equation is equal to budgeted sales minus break-even sales.
Break-even sales.
That's right. Margin of safety is equal to budgeted sales are given.
Budget sales or actual sales?
Actual anything budgeted sales or actual sales doesn't matter. A sales level which is given. So we can put it here as actual sales. If it, at the time of planning it is considered, it is called as budgeted sales. If it is the real scenario is present to us, it is called as actual sales. Anything, it doesn't matter. Any sales level which is over and above the break-even sales is the margin of safety. Okay. Now we know the annual sales or the budgeted actual sales are 640,000. What are break-even sales is what we have to find out. So let's check that. Break-even sales. Break-even sales is equal to fixed cost divided by, because there are two products, the denominator will become weighted average contribution by sales ratio. The fixed costs are given as 200,000 divided by, let's put this one in the denominator. The proportions are in the ratio of 3:5. Okay. S gives a contribution by sales ratio of 32%. T is 48%. So 3 into 32% plus 5 into 48% divided by, we have 3 plus 5. Check the calculation. $84,000. If it is 84,000, Actual sales, we have it as, is it only 84,000? Oh, break even sales are only 84,000.
Ma'am,
Hmm.
I'm getting the break even as 4,76,190, ma'am.
I might have made a mistake. That's why I'm verifying, because it cannot be as low. The 640 and this is only 84. So that's why I'm verifying it. Tell me, how much is it?
4,76,190%, ma'am.
Where did I go wrong? 3 into 32%. And 5 into 48%.
Ma'am, I got the weighted average as 0.42, ma'am.
Ah, 0.42. Then is equal to 200,000 divided by 0.42. Okay. I wrote the formula wrong somewhere. Maybe while inputting the data I did. But otherwise it's coming as 476,190. That is break-even sales. The space is not there. I'm writing it here. The budgeted sales are 640,000 minus the break-even sales are 476,190. So that is 163,810. So I'm putting it here only. Space is not there. I pasted all of them together. So the next question is starting in the next line. So I both of you can understand, I guess, how we've done. The formula says margin of safety. So margin of safety is 1,630, 163,810 divided by the budgeted sales or actual sales are 640,000. The whole thing into 100. Is this the is this the answer? 25 point something.
From 25.6.
Yeah. Okay. There's no space here, so I just adjusted here. I hope you both can understand it later on, even if when the file comes to you also. The next question is 196. A company provides three different levels of customer service support for one of its software products. The following data relate to these three levels of support: superior, standard, and basic. That is dollar per contract. We have for these three products annual fee, annual variable cost, annual fixed cost, and then profits are given. The total annual fixed costs are budgeted to be 1 million. None of these costs are specific to any type of customer service support. Assume the number of customer service support contracts sold are in the proportion of 20, 30, and 50%. The annual revenue that needs to be generated in order to break even is closest to. I guess in this little similar to the one which we have done before this 194. The percentages are given. Okay. Weights are also given. Annual fee 1,750, 400. Let's write. In order to generate break-even sales. So break-even sales is equal to fixed cost divided by weighted average contribution margin ratio. That is the break-even sales. Break-even sales is equal to so three products: superior, standard, and basic. We have the annual fee, we have the variable cost, and we need to find out what is the contribution margin, find out what is contribution margin, and then find out what is the weighted average contribution by sales ratio. Weights are given as 20%, 30%, 50%. So let's start with the first product is superior, then we have standard, then we have basic. The annual fee is given 1,750, then 400. Variable cost is also given 450, then 250, then we have 180. Then contribution. So weights are given as 20%, 30%, and 50%. So the weighted average contribution margin will be 370 divided by 100%. 100% is 1, so it would be the same. 370. Fixed cost, annual fixed costs are 1 million. So break even sales is equal to this is 2 we got 2702. Where did we go wrong? I made a mistake somewhere. Please look into that. Not the answer. Okay. If that is the case, annual revenue is generated.
Ma'am,
Per contract. These are per contract values. So per contract contribution is weighted average contribution per unit or per contract is 370. So if we divide it by 370, it comes out to be 2703 contracts. Then the total revenue. These details are per unit details. These are per unit. So contribution per contract. So weighted average, weighted contribution per contract. These are not percentages. Weighted contribution per contract comes out to be these are number of contracts. Proportions are 20, 30, 50. So superior will be 2703 3 into 20%. So number of contracts will be just multiply into the fees per contract. So if we multiply into fees per contract, then we would get what is the this is break even sales, or we have it as 1 million, round it off to the nearest 1000 because that's how the values are given. 690. A bit is the answer. We This weighted average is not the percentage. These are not percentages. These are only amounts. Contribution per unit. No. So this is weighted average contribution per unit. So when we have it as per unit, the value what we get is break even sales in units. It is not in rupees value. So break even sales in units. If that is the case, then these number of units should be split among these three types of contracts in the proportion of 20, 30 and 50 because these are the weights. So when we have split that into these proportions, we got these as the number of contracts. Number of contracts into the revenue per contract, the fee per contract when we multiply. So these are break-even units. Those are break-even sales. So break-even units. So break-even contracts into the revenue annual fee per contract. When we multiply, we got the sum total as this much, or make it as and round it off to nearest thousands, 1,690,000. One by one, I'll get because place is not getting. It's not sufficient. I'll get one question, one at a time. 197 question number. Question number 197. R&K company manufactures a product that has a selling price of $14 and a variable cost of $6 per unit and incurs annual fixed cost of 24,400. Annual sales demand is 8,000. A new production method is currently under consideration that would increase fixed cost by 30%, but would reduce variable cost to 5 per unit. The superior quality of the finished product would enable sales to be increased to 8,500 units per annum at a price of $15 each. If the change in production method were to take place, what would be the break-even output level? If the change in the production method were to take place, so there are certain changes which are mentioned because of change in the production process. A new production method is currently under consideration that would increase fixed cost by 30%. Earlier it was only 24,400. Now that will increase by 30%. So first make the change for the fixed cost. After that, variable cost also will reduce by $5 per unit. Um, the superior quality of finished product would enable sales to be increased to 8,500 units per annum at a price of $15 per unit. The question is asked us to find out what is the break-even sales after the new production method is introduced. But the options which are given are 500 units higher or 372 units higher. So when can we comment about whether it is higher or lower? Only when we have it as on a comparative basis. So let's do that on a comparative basis. Columnar wise, we can put it. The equation what we have to use is what is break even sales in units is equal to fixed cost divided by contribution per unit. We can have it in a columnar form, that is present, then have it proposed. What is fixed cost? At present fixed cost is 24,400. It is expected to increase by 30%. So it becomes 1.3. Then we need to know what is selling price, variable cost. Selling price per unit is 14. Variable cost per unit is equal to 6. So contribution per unit is equal to break even point in units. Now for the proposed one, the superior quality of the finished product will enable the sales to be increased to 8,500 at a price of 15 each. So 15 is the selling price. Variable cost, but would reduce variable cost to 5. So this is 5. difference is that the answer? So 122 units a year. XYZ company sells 3 products. Product X has a contribution to sales ratio of 40%, Y has a ratio of 30%, Z is 35%. Monthly fixed costs are 200,000. Total sales revenue sales of the product is in the ratio of 3 is to 7 is to 5. The monthly break-even sales revenue. I think you can do it. Quickly present it because fixed cost divided by weighted average contribution margin ratio. Contribution to sales ratio is already given. So I think we can quickly present it 198. Tell me how much is it? Otherwise, I will.
Ma'am,
I know. 3 plus 7 plus 5. 15. Did I make a mistake anywhere? Just help me out.
Ma'am, the weighted average is 33.67%, ma'am.
40% into 3, 30% into 7, 35% into, here it is 7, not 5 only. Tell me, how much is it?
33.67%, ma'am.
It's 7. Where did I make a mistake? I'm not cross verifying it, my solution here. The reason is it's a very basic question. So that's why I'm not doing that. So nearest 1000 will be 594,000. Is that the answer? Okay. Then 198 after that.
Yes, ma'am.
Now 199, it's pasted here. 199, a company has only a limited available supply of direct labor and direct materials. It manufactures two products X and Y, for which there is unlimited sales demand at current selling prices. The source requirements for each product are as follows. Material is 2 kgs, 4 kgs, direct labor is 3 hours, 1 hour. The company seeks to maximize its profit. Each unit of product X earns a contribution of 12 per unit. The minimum contribution that must be earned by a product of by a unit of product Y to make it worth producing units of product Y in a profit maximizing budget is, see, a company has a limited available supply. So limited, there are certain factors which are limited in nature. uh, it's not that all the resources all the time are available abundantly. There may be certain things which are not abundantly available. So here also we see that situation is a company has only a limited available supply of direct labor and as well as direct material. It manufactures two products X and Y, and there is unlimited sales demand. Any number of units which are produced, they can be sold in the market. But to take up the production itself, there are certain constraints. Here it is mentioned about direct labor and direct material as constraint or limiting factors. So now, in that case, there is also one more thing which is mentioned, that each unit of product X earns a contribution of $12 per unit. The minimum contribution that must be earned by a unit of product Y to make it worth producing units of product Y. So X anyway it's given as 12. How much should be the contribution per unit of Y? In that case, uh, they would be able to maximize their profit. The next topic what we have, it is in our syllabus is, see, there are two constants when there are The situation is about limited factors. Limited factors or limiting factors, what we call it as. If there is only one constraint, we use limiting factor analysis. That is, key factor analysis will be taken up. But in this question, we have two different constraints. When two constraints are given, then the technique which is used or the analysis tool which is used is called as linear programming. So that's the next topic what we have. But today time is not there. Linear programming is the technique which has to be used, but explaining that it takes little time. So right now I'm not taking it up. So the point what you have to remember is when only one factor is limiting, either material or labor or anything, any one factor is limiting, limiting factor analysis will be taken up, or key factor analysis what we call it as. But if it is more than one variable which is limited in nature or limiting or constraints, here two are there, then linear programming technique has to be used. But linear programming technique here, I still have not explained that, so time is only very little time is there, I cannot take it up right now. So let's check the other questions from the examination kit which are related to break-even analysis. When we do that, we'll come back to 199. 200, I think 200 and 201. Two questions are there. The budgeted profit statement for product X for next year shows that it has a margin of safety equal to 20% of budgeted sales and a unit selling price of 10. Product X has a contribution to sales ratio of 60%, budgeted fixed cost of 120,000 for the year. The percentage increase in the unit variable cost that would result in product X breaking even at the budgeted level of activity is dash percentage. Margin of safety is 20%. Budgeted selling price is 10. Contribution to sales ratio is 60%. Fixed cost is this. So their break-even level should be at the budgeted level of activity. Selling price per unit is given as 10. Then we have contribution by sales ratio given to us as 60%. So contribution is the question is asking us about the variable cost. So the question is focusing on variable cost. Variable cost obviously will be 4. 10 minus 6 is 4. So sales minus variable cost is contribution. Sales minus contribution is variable cost. the percentage increase in unit variable cost. So they're looking at a change in the variable cost. If the percentage increase in unit variable cost, that would result in product X breaking even at the budgeted level of activity. But what's the budgeted level of activity? That is not known. We only know what is margin of safety, which is 20% of the budgeted sales. So how much is the budgeted sales? That is not known to us. 20% of the budgeted sales, and these are the details which are given. Now break even should be equal to the budgeted sales. So at the budgeted sales level, at the break even sales level, what is the logic we have learned? That the contribution and the fixed cost would be same. The budgeted fixed cost is at 120,000. If it is 120,000, the contribution which is generated should also be equal to 120,000. Percentage increase in unit variable. Break even point is this margin of safety. So budgeted sales will be 80%. Is it 80%? Margin of safety is 20%. Budgeted sales is 50 units. It is X. I don't know. I'm just working out. One second. I'll give you clarity. Even I am not able to understand the question part of it clearly. If margin of safety is this, then what's the question? Why margin of safety? Budgeted sales are 300 and 103 75,000. contribution will be 6. Okay, got the point. If this is 25,000, but margin of safety is also not needed. This is the data which is given. We have selling price 10, contribution 6, and variable cost is 4. Fixed cost is 120. The point what is given here is margin of safety is 20% of budgeted sales. We do not know what are budgeted sales. So if we present it as budgeted sales, if it is 100%, margin of safety, it's given as 20%. So obviously break even sales, because we have the formula margin of safety is equal to budgeted sales minus break even sales. So break even sales will be obviously 80%. If that is the case, we already calculated what is break even point. Break even point is equal to fixed cost by contribution per unit. So fixed cost is 120,000 divided by 6 gives us 20,000 units. If break even point is 20,000, which is 80%, if these are 20,000 units, we can find out what are budgeted sales. So 20,000 into 100 by 80%. So we have this one calculated as 20,000. Just check this one. 20,000 divided by 80% gives us budgeted sales. Now that's the point. They want to have a break-even sale which is equal to budgeted sales. So the change what they are looking at is the change in the variable cost. So break-even sales would be equal to 25,000. But the only change what they are looking at is the change in the variable cost. Now, variable cost, let's take it as X. Okay. See the concept of break-even point happens at where fixed cost is equal to the contribution. So now what is the contribution which is generated at 25,000 is what has to be calculated, and that amount should be equal to the fixed cost. So what should be contribution? Fixed cost is equal to 120,000. So contribution also should be equal to 120,000. Fixed cost is equal to contribution, which is equal to, we already have that with value which is 120,000. So now they have to earn a contribution of 120,000. So at 120,000 contribution only break even point happens. So on the other side, we have 120,000, but the number of units which will be sold are 25,000. 25,000 into the contribution margin. 10 is the selling price, unchanged, but only the variable cost would change. Some variable cost considered. Earlier, the variable cost was 4, but now it should not be 4. It should be something else. when the change in variable cost is made and the break even point happens at a sales revenue of 25,000 units and giving a contribution margin of 120,000. So many adjustments, my God. So variable cost, this goes together, is equal to 250,000 minus 120,000. No, 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 is equal to 120,000 divided by 25,000. 10 minus variable cost. So 10 minus variable cost is equal to 4.8. So variable cost is equal to 10 minus 4.8 is equal to 5.2. If it is 5.2, earlier variable cost was 4. Now 4 and 5.2, what is the percentage change? Percentage change in variable cost is equal to the difference in the variable cost by the base, which is 4. So difference in the variable cost is 5.2 minus 4 divided by 4 is equal to 1.5. 30%. It's a complicated question. So many points are there in the question. Looks so small, but there are so many points. The given data set has the selling price, variable contribution margin, variable cost, fixed cost. So with this information, break-even point can be calculated. But the question is so twisted. It says that there should be some change in variable cost, which would enable them to break even. The break-even point should happen at the budgeted level of activity, but nothing is given. Only the present break-even point is known. So now they have to consider first calculate what are the budgeted sales. But no, we don't have what are budgeted sales. First arrive at what are budgeted sales. The equation of margin of safety is equal to budgeted sales minus break-even sales. The only information what we have it as margin of safety is 20%. If margin of safety is 20%, budgeted sales is calculated on margin of safety is calculated on budgeted sales, which is 100%. And 100 minus 20% is 80%, and that is break-even sales. If break-even sales being 80% stands at 20%, so budgeted sales is what percentage? So that is what has to be calculated. So if that is what we are calculating, budgeted sales comes out to be as 25,000. Now 25,000 units at which they should break even. That is one condition. If they have to break even at 25,000 units, okay, then in that case, the break-even point happens at one more condition is when the fixed cost and contribution are equal. So considering 25,000 unit sales and contribution which is earned, that contribution amount should be equal to the fixed cost. Fixed cost is 120,000. So the contribution should be equal to 120,000. Selling price is unchanged. 10 minus variable cost multiplied into 25,000 units is equal to 120. So we calculated and the new variable cost, if it is 5.2, the whole thing will be satisfied. Then the next part of it says that what is the percentage change in variable cost. Earlier variable cost is 4, now variable cost is 5.2. So the percentage change in variable cost is 30%. Okay. One more point. Tomorrow I'm on leave, so I will not take the class tomorrow. Some other day we can schedule this. Following the day after tomorrow, we have a class, so we'll meet as it is. So I will let you know when would we have another class. I think one more class will not be sufficient because there are two topics left. So even if we finish these questions, let me put you through the PDF. I know it's time, but I'll just brief you up. Now this is, we are at 200. I think 240 till then. See, another 10 questions are there for break-even point, break-even analysis. Then comes from 211 linear programming. Linear programming, not much is there. It not very advanced questions are there. Even if we take them up, the next topic what we have is risk and uncertainty. So this is all linear programming. The concept has to be explained to you first. After that only we can work out. This is all linear program. Then comes risk and uncertainty. So two major topics are there. So we have only, according to the schedule, only 2 days are left. So I may schedule one more additional day. So risk and uncertainty, if that is taken up, risk and uncertainty also has certain sections like we have to learn minimax, maximax, all those things. And value of information has to be learned. Then we have the decision tree criteria. So maybe I may require another one or two classes. I will let you know. Tomorrow we are not having a class because I am going on leave. After that, day after tomorrow, anyway, according to our schedule, we have a class. So we'll first meet on that day. Then I'll let you know about what are the other days. Okay. Okay then. Good
Okay,
day.
ma'am.
Good day.
Thank
Thank
you,
you,
ma'am.
ma'am.